I think that's one of the things that's unique about us is because of the complex integration, we have something that it would be difficult for large exchanges to compete against.
Ladies and gentlemen, welcome to the TraderCobb Crypto Show and podcast. My name is Craig Cobb, and I have the pleasure of speaking with a man who has a different take on the exchange platform that we're used to. And I look forward to bringing that to you through the CEO of a company called Coinflex, Mr. Mark Lamb. Thank you very much for being on the show.
It's absolutely great to be on the show. Yeah, great to be here.
Good stuff. Well, look, as I often do, mate, first things first, I would like you to introduce yourself and tell us a little bit about who Mark Lamb is and where you've been, what you've done, and why you started Coinflex.
Yeah, absolutely. So I got into Bitcoin in 2012, back when Bitcoin was single digits. I basically started looking at it because I was creating a virtual currency startup at the time that was sort of around loyalty points, and I was also exploring cryptography and economics and looking at the monetary system. And I found Bitcoin, and it just seemed like the natural sort of this incredibly elegant and beautiful designed solution to a number of societal problems. And so got involved, started buying a little bit, and then kind of went all in and started market making it in the UK, and then created Coinfloor, which was the first UK Bitcoin exchange. And a few years ago, we realized that derivatives were going to take over the world. And so we started working on a physically delivered futures exchange. And that became CoinfloorX, which became Coinflex. So we moved out to Hong Kong, and basically the rest is history.
Wow. And so you said 2012, so you were buying Bitcoin in single digits.
Yeah.
And did you keep it? Like, obviously Mt. Gox hacks, all the stuff that happened back through that period. I mean, for you, I guess it's a bit of a different take because you were studying a lot of different things in that, like the cryptography, the financial system, that sort of thing, digital currency and all that. What you had a different take on it. It wasn't just like, I'm buying it because I'm on Silk Road or something like that, which a lot of people, that was their first introduction. I got no qualms about saying that. So you held it, or did you get attacked?
Yeah, when I got into Bitcoin, I thought this was probably going to be worth $3 million per coin one day. I think now the monetary supply is increased, so I'm a bit more bullish than that. But I would say I kept most of what I purchased. I'm still very long, and I spent some of those Bitcoin on starting the exchange, and kind of investing in the ecosystem. But yeah, Mt. Gox was a really real blow. But for anyone who was sort of deeply involved, I think it was pretty obvious what was going to happen. And so I had no exposure to Mt. Gox at the time of the crash.
Well done to you. So Coinflex, let's discuss that. Obviously, you've been around the market for a long time, and for reasons, as I say, more intellectual reasons, perhaps we could call it, than just happening to stumble across Bitcoin, or for other nefarious reasons that you became a part of the ecosystem and got involved. How long has Coinflex been around for you? It was CoinFX, or you mentioned it a moment ago. What year did you start this business?
So we launched as Coinflex in 2019. So yeah, it's been around since January 2019. As previously we sort of spun out of Coinfloor as CoinfloorX, but separated from Coinfloor entirely, and launched anew as Coinflex in 2019.
Okay, so it's been around for a good number of years now. I mean, look, it's 2 years, but let's be realistic. In this space, 2 years is actually quite a long time. 2019, Absolutely. You had to hang on through what was a little bit of a messy year. Obviously, the back end of 2020 really was when the action started, and I suspect that your business may have grown. So we know that there's lots of exchanges out there. They are a dime a dozen, Mark. Why does the world need another bloody exchange? What is happening here? I know they're lucrative, don't get me wrong. I know they're a good business model if you can get enough clients and enough volume and blah, blah, blah. But for you, somebody who's been in Bitcoin for that long and sees, obviously you've seen massive rise in the value of Bitcoin, and of course, therefore, your bottom line, your wealth. What drove you to start Coinflex and to go the direction you're going? And what is that direction? What makes it different to the other exchanges that are out there?
Yeah, I mean, the world doesn't need that many exchanges. The network effects of liquidity begetting liquidity are really enormous. So really, if you're not a top exchange, there's almost no point. And if you don't have a solid plan to get there, there's definitely no point. So I do very much agree with that statement. The world doesn't need more exchanges. But what I would say is most of the exchanges today are very focused on traders. And although traders are the best customers for exchanges because they pay daily fees, they're in the market every day, day in, day out. The majority of the world are actually, they're either not traders, or if they do trade, it's a very passive style of trading or a passive part of their time. And so what I would say is for that part of the world, I think they're relatively underserved in the exchange space. There are some products in crypto that are built towards the passive investor or the passive trader, but there's not loads of them. And most of the products that do exist are not very transparent. They don't give the bulk of the economics to the user. They end up taking a fat margin for themselves. And, it's not really clear what's actually going on in the back end. So we view ourselves as the home of crypto yields. And that's because we have a number of two main yield products, but a very flexible set of yield products that allow people to earn money from the activities that are happening within the exchange ecosystem we've created, providing liquidity effectively, without having to do much effort or manage their activities very much. So they can very passively earn this yield. And the two that are the main products around this are the flexUSD product, and that's a stable coin that pays interest every 8 hours. Right now it's paying around 20% annualized. And it's grown from 100 million to 300 million in the last month. And the other product is the automated market maker. And that effectively allows any individual to compete head to head with the biggest prop trading firms in crypto and the biggest hedge funds in the traditional markets, and provide liquidity in these futures markets. And so that's something retail and casual and passive investors have never really been able to do before. And our automated market maker allows people to do that with just a few clicks. So
you're sort of going full circle, I suppose, back to, look, exchanges sort of went spot. It was all about spot. Yeah. Then sort of, BitMEX was probably one of the ones that really came onto the map, with Bitfinex as well. Then that sort of skewed off because the products were terrible. It skewed off, and I went to FTX because FTX had a great platform there that facilitated the needs for a trader like myself. And there are plenty of those available out there. Bybit's another one. There's so many futures platforms and perpetual trading platforms and products that there are lots of them. But what you've effectively done is, yes, you've got the futures element. You've got the perpetual contracts there as well. But it sounds to me like you're going back to the beginning days, but offering a different product in terms of, we're going back to the HODLers, back to the people that buy and hold, do their research, and might only trade 10, 15 times, 20 times a year. But what you're doing is you're offering them a very good yield-based product through the flexUSD. Is that step one?
Yeah, absolutely. And I think it's worth just explaining what the flexUSD does. So perpetual futures, and probably a lot of your audience will be very familiar with this concept. Perpetual futures have what's called a funding rate attached to them. And so they basically, they have this funding rate. It's a floating rate. It changes in some cases every hour on Coinflex, and on some exchanges every 8 hours. And sometimes these rates, I don't know if people, sometimes people don't pay attention to them, but sometimes these rates are quite high. So they often do go to 50% annualized or even 100% annualized. And that's really expensive if you're a trader, because let's say the rate is 100% annualized. You basically have to, if you're, most traders, in crypto tend to be long more than short. And so you have to basically outperform a 100% annualized benchmark just to break even. So, you know, I like to think, you know, there's a lot of good traders in crypto. If your hurdle rate just to break even is 100% annualized, you know, the game is just stacked against you.
Yeah.
And that's horrible. And they're not always 100%, but they're often very high. And you know, if it's 40 or 50 or 100, point is it's an extremely aggressive rate. And that's the case, especially when the market heats up, when traders are most interested. And this is because these futures exchanges, FTX, Binance, many of these futures exchanges are all cash settled perpetual futures that have no real easy way to deploy dollars into calming this funding rate and earning this funding rate. And so if you want to earn the funding rate, you have to basically be a hedge fund or an algo trading firm that can buy spot and sell futures a tiny amount at a time in huge size, paying fees each time. You know, even for these hedge funds and algo traders, it's very expensive to do this trade. So they don't do it enough. And that's why the rates are so high. And so on Coinflex, we have this easy mechanism. It's a one-click trade. It's called repo. No one on Coinflex has to understand it. They just benefit from it behind the scenes. But this repo trade effectively puts you into this long spot short futures trade in one click, in one go, with no fees. And it's a really cool mechanism, because if you are looking to capture this funding and be on the earning side of it, you can just do that in one click. And what we realized is, you know, people don't want even to trade repo. They don't want to do that to earn the funding. They just want to mint a stablecoin. So we made the interest collection process even easier, and we said, oh, here's a 1-to-1 dollar-based stablecoin, and you can just earn the funding rate that way. And it's going to be, you know, we're going to deploy all the dollars backing this stablecoin into repo, you know, based on a supply interest rate curve. And whatever money is earned in that pool of dollars, we're going to give 90% of that to the users. So unlike Tether and USDC and many other stablecoins, where the companies that issue those stablecoins, they keep all the interest. Tether keeps all the interest for the dollars that they lend out. flexUSD is great because it gives 90% of that interest back to the user. So it's a really cool product. And the best thing about it is it's great if you're a trader on the exchange, even if you don't use flexUSD, because you know that there's a huge wall of dollars. Now it's almost $350 million that is basically earning that interest, and thus keeping the interest rates low and stable for you, lower and more stable than they would be on FTX and Binance and many of these other exchanges. So it's really good for the end users, even who don't use flexUSD. But obviously it's an amazing deal for the flexUSD users as well, because they're getting these kind of 10, 20 +% rates on their dollars, and they're doing it with no effort.
And is that, so when you say it's under, so as a stablecoin, obviously the whole Tether saga continues about being, you know, underpinned by 1-to-1 dollar per USDT. Now, I suppose when it comes to flexUSD, with it being a stable coin, it's got to be one flexUSD underpinned by one USDC. Is that right?
Yeah, so it's underpinned by one USDC or one USDC worth of repo positions in Coinflex. So you know, the money is not always sitting in USDC. If it was sitting in USDC, we wouldn't be able to pay users interest on it. But it is always backed by $1 worth of collateral. So it's always fully collateralized by, you know, if there's $1 worth of flexUSD, it's fully collateralized by $1 worth of collateral.
Wow. Now, when it comes to, because look, the whole yield conversation has become much more prominent over the last sort of 8-9 months. It's probably become more prominent, and it tends to become more prominent when we see interest rates so low. They've been low for quite some time. Bonds have only just started to pay something of a yield, but they're still micro, right? Still so small. And the third factor of that is typically after a big run up, which we of course saw running into the early stage, or late last year into the early stages of this year, sort of fizzling out around April, May-ish. For those like people like me that do take profits back into stable coins and do understand how the market works and make their decisions based on taking profit, not just buying,
Yeah.
then it opens a conversation for us to start to put that hat on and go, geez, we've got a fair bit of money sitting over there in stablecoins, not doing a great deal. What can I do that's relatively safe with that money? Now, the biggest concern that I have had, and I'm not sure if you're going to be able to help with this or not, is that I look at my stable coins sitting on my Trezor wallet, right? And I go, oh, I could put them over here in Celsius, or put them over here in crypto.com, or put them over here. There's a myriad of different products. But my concern has always been that, you know, if I put that much over there and I make X amount per annum, that's great. But to make that much per annum with the risk being that high, to me, that's a bad trade. It's like the risk is that the collateral that I've put forth is gone. And I've you know, maybe had a year of getting, yay, I've got a little bit here, which is still held back on the same platform. So that's gone too. So how are you able to eliminate that risk? Because that's the biggest concern that I have.
Well, the biggest thing with all of these other platforms is they are not transparent about where the yield comes from. So if you look at any of the platforms you mentioned or any of the other platforms, I think it's pretty much universally the case that they don't say, you know, they'll make vague statements about, you know, it's crypto collateralized borrowing, and it usually is crypto collateralized borrowing. But the point is, they're not putting out numbers about what's actually going on, you know, behind the scenes. And the cool thing about Coinflex's product is it's actually open source. So the code that deploys, you know, these dollars into our repo market is open source. You know, you can see the balances of the flexUSD account. You can see the trades of the flexUSD account. It's all online. You can see all the different interest rates. They're all public. And you can also see the interest rates compared to our perp funding rates, which are public as well. And so unlike these sources, at the end of the day, I'll let your audience in on a little secret. These guys, all these other platforms, are lending to people that are lending into the futures market. So the yield in crypto is coming from either two places. It's coming from either DeFi yields or the futures market. And the biggest one of that is the futures market in terms of open interest. So let's just focus on that one. That yield is basically means that if you're lending to a platform that is not a futures exchange, that's then lending on to trading firms that are then deploying it into the futures market, you're back to the same old banking system we're trying to leave. You're paying a bunch of middlemen, a bunch of fees to do a bunch of automated things, when instead you could just be minting flexUSD. Yeah, we'll take a 10% cut, but everything is transparent. If the futures rates spike up to some really high rate, you're getting that entire rate. So it's just a much better deal for users when there's fewer middlemen, there's fewer manual operations. It's all automated, and it's all transparent on the same platform that the yield is actually coming from. We have an incentive to not make a lot of money on flexUSD because, in part, flexUSD is subsidizing cheaper perp rates for our futures traders. So we don't care about making all of our profits from the interest rate spread on flexUSD. We don't need to. We make money when people trade futures as well, and when they use the AMM. So that's in part why flexUSD is such a good deal for users, is because really it's all transparent, and we're trying to build a whole ecosystem here.
But is it sitting on your platform, or is it sitting in my Trezor or Nano or whatever? Ledger?
Yeah, so that's the cool thing about it. The collateral is all sitting on our platform, and it's all one-to-one collateralized on our platform. But you can take the flexUSD out and put it on your Trezor, your Ledger. You can put it anywhere you want, and you'll still earn that yield. So unlike with protocols where you're staking something and you're locking it, you can't use it for trading or for collateral or to pay people or something like that. You can use flexUSD on a Trezor and earn interest. You can use it on Coinflex as collateral to trade futures and earn interest while you trade the futures. So you can do a whole bunch of things, and I think more over time, but you can do things with your flexUSD, or you can keep it in cold storage and still earn interest while it's in that cold storage or while you're trading those futures contracts.
And that would then be paid back to the user in flexUSD?
Yeah, it's the interest is paid in flexUSD, so it's auto compounding.
And you can unlock over what period of time? It's usually like 7 days or 2 weeks for that sort of stuff. What is it with you guys?
So there's an instant option that usually costs less than 5 basis points. And then otherwise it's 8 hours if you want to get it for free.
Oh, wow. So within
it's
24
really
hours, you
fast.
can withdraw back. And would that mean that your Flex USD is then converted back to USDC, or it does?
Precisely.
And then it goes
one to one
to your Trezor or whatever.
Yeah.
And you're
exactly.
out.
Yeah.
With your so if I say put 100,000 Flex USD in and ran that for 6 months, and let's say that I made 10,000 USD, the 10,000 would that be sitting on the Coinflex account, or would that be sitting on in my wallet, in the contract with the wallet? Sorry, in the wallet on that contract.
Yeah, that interest is earned directly to your wallet. So it's not sitting in your Coinflex account. In fact, what this allows is people who don't even have Coinflex accounts can use flexUSD and earn interest. And we've seen an uptick in that happening as well in some DeFi applications where people who don't even have flexUSD are earning interest on their funds. People who don't even have Coinflex accounts are earning interest on their funds on DeFi and on ledgers and stuff.
Wow. So, okay, let me just bullet point this because it's very interesting. I can get yield from flexUSD, whether it be through Coinflex or through whatever, but Coinflex seems like the easier way. It can sit on my cold storage. I will be paid in that flexUSD. I can unlock it instantly for 5 basis points or wait 8 hours for free. And even when it's sitting on my wallet, I can still trade futures and whatnot on Coinflex.
Everything is exactly correct, other than in order to trade the futures on Coinflex, you do need to deposit the flexUSD into Coinflex, but everything else you said is spot on, mate.
Right. Because that's kind of, I mean, look, I've got to be honest, I'm not looking at exchanges every day. I've got what I've got. But that feels pretty empowering to the users, really, because they can get yield. I mean, look, if so they can have, again, I know I'm repeating myself because I'm genuinely interested. So if I put 100 grand and I go, right, I find a trade on Bitcoin perpetual, I'm like, yeah, I want to get long on that. Do I just then go send 30 grand, say, over to fund the Coinflex account so I can take the position size that I deem necessary on the perpetual contract, and it happens pretty quickly?
Yeah, exactly. And you can fund in flexUSD, you buy the contracts, you sell the contracts, you're back in flexUSD, you're earning interest the whole time.
Oh, you're earning interest the whole time?
Even while you've got the trade on.
And that's on your BTC USD perp contract?
Any contracts, yeah.
Because your perp part is your flexUSD.
Yeah, the perp is a BTC USDC contract, but the margin can be flexUSD. So we're very flexible on margin. You can post in BTC, you can post in ETH, you can post in USDC, but you can also post in flexUSD. And people love posting in flexUSD, depositing flexUSD and trading on futures because, they might be paying a funding rate on the perp,
but they're
themselves. Getting an offset. Yeah, they're paying themselves. So it's a great feeling.
Man, it's a pretty clever system. And, I can understand why you've gone from 100 million in flexUSD to 350 or thereabouts in the space of a month, because I suppose the more people you're talking to, the more interest you're gathering and gaining, because it's like an all-in-one shop, really. I mean, with the additional security of security, you can have it in your cold storage. So look, I understand the whole flexUSD bit, right? I get that. Talk to me more about this AMM. I want to understand that better.
Yeah, absolutely. So the AMM is really interesting because for several decades, sort of prop trading firms and hedge funds and sort of high finance players have emerged and built this ecosystem around capturing spreads between the buy price and the sell price. And they're really, they're trading. They're at the end of the day, they're trading just like anyone else. They're just doing it very, very quickly. And they're typically arbitraging. So they're typically buying here and selling there, or they're holding a position, but they're holding it for a very short time period. And when you think about these players, they are financial players just like anyone else. They have a certain amount of money and they have a certain amount of people. I would say the number of people that are doing this is probably way below 1% of Earth. So it's probably even below 0.1% of Earth or 0.01% of Earth. So it's a very small number of people. And when you think about the capital they have, they don't have unlimited money. You know, people think of hedge funds and prop firms as these $1 billion. Yeah, but $1 billion at the end of the day, how much do retail investors have? How much does the general public have? The general public has tens of trillions of dollars, maybe $100 trillion. So I think what we haven't seen yet is general public participation in market making, and it's something that is the next logical step in the evolution of markets, electronic markets, and definitely and definitely it makes sense that crypto leads this evolution because crypto is inventing all the cool stuff in finance. And so what we're trying to do is say, hey, if you've got, you know, $1,000, $100,000, $1 million, and you know you're not looking to hire a team and start a market making firm, but you are interested in making the high types of yields that market makers often make. You know, a lot of market making firms make 50, 100, 150% APR. You know, they're making really good yields. The problem is it's very expensive to set that up. You know, it takes a lot of people, a lot of time, a lot of money. So what we're trying to do is lower the cost of setting up market making infrastructure. And we basically created an interface where you can take your money, you can set some parameters. So you set a buy-in and kind of minimum max range. You set whether you want to be net long or net short or neutral, kind of long and short. Yep. And you basically can control, okay, I'm happy to be buying, let's say it's Ethereum. I'm happy to be buying Ethereum between 3,000 and 4,000, and above 4,000, I want to be fully out. Or I want to be collateralized in Ethereum, buying more from 3,000 to 4,000, 1x leverage, and at 4,000, I'm out and back into my Ethereum collateral. And so this is really interesting because it allows people to earn on the volatility of these crypto assets. When you think about crypto, it's all over the place. ETH goes to 4K, then 2.5, then 3, then 3,500. And the guy who's just bought it at 3K and he's seen it go from 3 to 4 to 2,500 to 3,500 back to 3, he's got nothing because he's still in, you know, he bought one ETH at 3K, it's done a whole bunch of stuff and it's back to 3K. So he's made no money in terms of return on his dollars. Yeah. He loves ETH, he's passionate about it, but at the end of the day, he's in it to make money. And so the guy who's just holding spot Ethereum, you know, is missing out. And what we're trying to say to that guy is, hey, take some of your Ethereum and you can put it into these AMM positions. And in these AMM positions, you're going to be trading around that range. So you might have an ETH collateralized AMM where you're going to be buying ETH from 3,000 and selling out of it at 4,000. And every time you buy, you're going to be placing a sell order one tick higher. So maybe 10 cents higher. Every time you sell, you're going to be putting a bid one tick lower. And you can control your risk. You can control your price range. You can control whether you want to use leverage or no leverage. And basically, it allows you to earn yield on dollars, Ethereum, Bitcoin, any type of crypto asset from the volatility of any of these crypto assets. And so it's a very powerful tool because when you think about other exchanges, all exchanges are competing on liquidity. The most liquid exchange wins. And what we're trying not to say to traders is, hey, you know, come to an exchange that might be less liquid than Binance, the #1 futures exchange in the world. Well, that's a hard sell. You know, if I try to say to a trader, come over from Binance, you know, it's like, well, Binance is more liquid than you. Why should I go to Coinflex? But if I try to say to a coin holder who's got some ETH or some dollars and is looking to earn yield, hey, come to Coinflex. We've got the only centralized AMM, the only futures AMM, and it's got way more volume, way more APR, way more yield than all the AMMs in DeFi because it's futures, not spot. That's a compelling proposition. And people are getting behind that really actively and really aggressively. And so I think that's what we're starting to see with the AMM product is because futures are such a higher turnover product than spot and at the end of the day, DeFi is spot on a blockchain. So it's slowed down spot, right? It's much slower spot. And spot is uncollateralized, fully collateralized, no leverage. right? So I think once you have an AMM in futures, it's a real game changer, because the average person, the passive investor, the passive trader, the casual trader, can now trade on the same level of frequency as the biggest hedge funds in the space. And we've got guys who are putting in 100K, and their AMMs are trading $5-10 million a day. So it's, people are trading, and they're not doing anything. They don't log in for 3 days, and the time they've logged in, they've traded $30 million. So it's great. It's just a really great tool for earning yield on your assets without much effort, and with complete control and total transparency.
And again, with that AMM, if I say use do it on Bitcoin futures, I say, right, I'm going to put in a Bitcoin, for example, when obviously so you can manage the risk and the upside, the downside, the way it works, because it is high frequency and it's after very small BPS each time, but lots and lots of them. Am I going to be paid in BTC, or am I going to be paid in flexUSD, or am I going to be paid in USDC? How does that work?
Yeah, so you're paid in a combination of US dollars, USDC, and flex coins. So flex coin is the exchange coin of Coinflex. It's the native token of Coinflex, and basically the interest, the yield that someone earns from the AMM is paid in a combination of trading fee rebates, which come in the form of flex coin, and those are paid by another trader. So another trader pays 4 bips or 8 bips, and then you're earning, as the AMM, you're earning 3 bips. And then also you're earning dollars from the P&L on the trade. So if you bought Ethereum at 3,122 and you sold Ethereum at 3,122 and 20 cents or 30 cents or something, that 30 cents is the dollar portion of the P&L as well.
Okay. And your market cap, I've just had a look at it here. You're sitting at, based on CoinGecko, 188 million. And that to me it's remarkably low. Holy moly.
Yeah. 10th
of July. Geez, you've gone bananas. Haven't you? You've gone from what? 23 cents to $2.40. So you've done a 10. Oh shit. No, no. Yeah. Wow. Well, the people certainly are getting involved in that. So you've just follow my mind. So you've got the exchange there with futures and perpetual contracts, because there's two different types, obviously. You've got the spot exchange there as well. You've got the AMM, which I can put in and earn good yield, good income from, essentially, without downplaying my account should I manage the risk and, should it all go to plan. You've also got flexUSD that I can stake, have it on my own cold storage so I can get yield and keep it safe. Yep. And you've got FlexCoin, which has obviously made you a very wealthy. Well, you already bought Bitcoin in single digits, so safe to say you already were, but it appears that it's doing very, very well. And it's only the rubber seems to have hit the road the third and now fourth quarter of this year, would you say? And is that based around AMM being released?
I think the reason for the rise in flex price, the 10x recently in flex price, and also the rise in flexUSD issuance as well, is mostly because of the AMM. So the vast majority of that is because of the AMM. And it's worth saying as well, all these products are very intertwined. So the more capital goes into the AMM, because some of the AMMs are leveraged, the more demand there is for leverage. And that demand for leverage really creates demand for flexUSD, right? So it creates higher flexUSD rates. So the more AMMs that get created, typically the more flexUSD that gets created. And then the more all of it gets created, the more our revenues go up, the more the fees that get paid every day goes up. And that all drives FlexCoin demand as well. So really the products on our exchange are heavily related. And one of them typically triggers the others to grow as well.
Right. For those on the podcast, I'm just sort of rubbing my bald head right now, going, yeah, okay, he's ticked most of the boxes there. That's it. It really is. What's your background? How do you do all this stuff?
Yeah, so I I like to say I'm kind of a financial engineer. You know, Sudo is my co-founder, and he comes from sort of the opposite background to mine. So you know, derivatives trader, sort of new to crypto when I was a crypto OG guy that was new to derivatives. And as much as I hate the term OG, but the I think the thing that Coinflex has an advantage is we have a lot of people on our team that are very, very focused on creating financially elegant products that are market-based, free market-based, and transparent, and put the users above the company. So really, we always want to put the users first. And from my perspective, this is because I am that user. I live in crypto. I don't have assets or money outside of crypto. I think about this stuff and live in it 24/7. So, you know, as someone that's living in this space, it's easier to come up with things. But also, we've been dealing with and working with and operating with some of the smartest minds in the traditional financial space. I worked closely with a lot of the guys at DRW. DRW was a shareholder in my last exchange. DRW is one of the biggest trading firms in the world. So I worked very closely with some of the guys at DRW. One of the former DRW partners, Mike Komaransky, is a very large Coinflex investor. So we have a lot of, and Sudo also used to work there as well, and has been, you know, partner at a bunch of different hedge funds and prop firms and stuff. So we have a lot of experience from the traditional financial space, including parts of the traditional financial space that like thinking outside the box. Some of these prop firms really like thinking outside the box, and it's important when you're trading at the highest levels of finance, you know, to think about outside the box and think about, you know, what are the edge cases and how does a product work, not just at the high level, but really at the deep fundamental levels. And so what we were trying to do is, at the end of the day, I've been in crypto almost 10 years. I'm going to be in crypto for the rest of my life. We're trying to build products that become the final, you know, category definer of the stablecoin space.
Don't say final with an S starting after it.
Final with an S starting after it?
Final solution. Don't say that.
Oh God,
I thought you were going to say we want to come up with a final solution. I'm like, no, don't say it. You'll lose everybody. No. I just lost everybody, but you get my point.
Well, you know, I think, you know, kind of Peter Thiel has this concept of you want to be the last mover advantage. You want the last mover advantage. You don't want first mover advantage. You know, sort of this idea of there can be certain markets where a market structure or a product structure or a distribution advantage creates something that becomes such a powerful network effect that it's very difficult to compete against it. Yeah. That's really what we're trying to do. You know, flexUSD is, I think it's an order of magnitude better than Tether. You know, it's I think it's hard to hold Tether when you have the option of holding flexUSD. That's my perspective. That's my perspective as a user of both of them. And we want to do that about all of our products. We want our trading experience to be 10 times better as well. We think our AMM is 10 times better than everything in DeFi. And 10 times is hard. You know, 2x is doable. A lot of people have a 1.5x. They might exaggerate. They call it a 2x. That's definitely achievable. There's a lot of ways to get a 2x, but becoming, you know, an order of magnitude better is really, I think, a complex process that requires a lot of integration across different product sets. It would be impossible to create this stablecoin if we didn't also have a futures exchange. It would, and it'd be impossible to create this AMM if we didn't also have the futures exchange and the stablecoin. I don't think this AMM would work on a Binance that doesn't have an integrated flexUSD into their perp funding markets. So a Binance can't easily create this type of AMM because their perp funding rates would go out of control. So I think that's one of the things that's unique about us is because of the complex integration, we have something that it would be difficult for large exchanges to compete against.
Yeah, and just coming back just briefly, you said, last user advantage. Your first mover advantage is people that they've got to time their exit, right? You've got to time your exit, you make your bazillions, and then off to the next thing you go. Last mover advantage is somebody who wants to be there, stick around, keep the business.
Exactly.
Big difference by the motives that drive the force and the products that therefore come out. It can't just be smoke and mirrors and sound good. It's actually got to be good and last the test of time. So look, I'm really happy that we had a good dig in, Mark, because I've definitely learned a lot. And generally, if I learn a lot, then my audience learn a lot with me. I generally learn more than them because they tend to know more than me on this sort of stuff. I just stick to what I'm good at. I'm good at reading markets and trading. But the technology side of this, you clearly know what you're doing. That you speak very assertively and you piece things together really, really well. I'm going to be looking a hell of a lot more into both the flexUSD, the AMM, and getting my hands on some Coinflex as well, because if this is to continue to gain traction, and I don't see any reason why it wouldn't, aside from you guys cocking up enormously, which is always a risk. But I'm sure you've got that risk parameters down under control as well. But I think that there is a lot of space here, considering your market cap at the moment. Is it fully diluted?
Yeah, so there's 100 million total. So the fully diluted market cap of FlexCoin is $240 million.
Right.
So unlike a lot of those, unlike a lot of those projects where most of the market cap is not circulating yet, you've got this kind of risk.
Yeah,
we don't really have that risk. So,
well, mate, look, I'm very interested to learn a lot more myself personally, and I'll probably have a chat to you after this unless you're busy. But thank you so much for your time today, ladies and gentlemen. Mark Lamb, who is the CEO, got a baby face, but I tell you what, a big bloody brain, and it's definitely worthwhile going and checking out Coinflex, the AMM project or product, and the flexUSD. It's simply coinflex.com, straightforward. Go get involved. And once again, Mark Lamb, thank you so much for your time, mate.
Thank you so much. Always a pleasure.
Ladies and gentlemen, have a fantastic day. I'll speak to you again very soon. Bye for now.